Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. It's July 16th. It's Friday. We made it to the end of the week. What's going on in the markets? Well, they started off up a little bit and now we're down a little bit. So nothing, no major fireworks yet. But what I want to talk today about is the stock market bubble. Now, how do I know? How do I know that we're in a bubble, and how big a bubble is it? And when is this bubble going to break? Finally, is it ever going to break? Can we just keep printing money and keep exploding the bubble higher? Maybe we can. I don't think we can. But how big is the bubble? Well, I think it's at least 50% overvalued. At least. Now, here's why. All right, you got the PE ratio of the S&P 500. It's at 44 right now. What's normal? About 17. So we're at 44. Normal's about 17. Now that's way over. It'd have to come down much more than 50% just to get to normal. Okay, that's one indicator. All right, Warren Buffett, he likes to use the market cap of the U.S. stock market compared to the GDP. Now the market cap of the U.S. stock market, these are approximate numbers. Let's call it 40 trillion, GDP running about 20 trillion. So it's at 200%. It's actually a little higher than 200%. But what's normal? Well, 100% is pretty normal. Below 100 is like the stock market would be cheap. Above 100, it's expensive. Right now, I think it's running almost 230%. 230. It's very expensive. It's over double. It's going to have to pull back at least 50%. And when they pull back, they do tend to overshoot. So this stock market could pull back as much as 70 or 80%. Some people are calling for a 90% drop. When the crash comes, I do believe it's going to be the mother of all crashes. Now, one more comparison here. Now, this is an ounce of gold, all right? This is a gold eagle. Okay, an ounce of gold right now selling for about, let's call it 1,800. Okay, the Dow Jones Industrial Average about, let's call it 35,000. 1,800, 35,000. Okay, that's like 19 to 1 ratio. 19 to 1. Now, what's normal? About 8 to 1, maybe 10 to 1, somewhere in that range. So once again, the stock market has got to come back 50% just to hit the normal. But here's the thing. The stock market always overshoots to the downside. Right now, we're overshooting to the high side. At some point, when this is all done, when this market finally crashes, when it's all over, what's going to happen? I say the Dow Jones Industrial Average will be equal, the same as 1 ounce of gold. So 1,800, 35,000. Now, is gold going to go up to 35,000? Possible. If they keep printing money like crazy, it's possible. Is the Dow going to come down to 1,800? Oh my goodness. That'd be like a 95% drop. Could that happen? Doubtful, but it could happen. And when you see the thing about the stock market, when it crashes, it happens very fast. It can crash like in one day. It can crash 50%. It could. It might. And that's real scary at these lofty prices. But I do believe that they will meet somewhere in the middle. Where? Probably about, 8,000, maybe 10,000. Gold at 10,000. People think I'm crazy. Gold is artificially low right now because you have major banks, major players that do not want gold to rise. They want it to remain low. And they are doing that, controlling the price of physical gold with paper gold. There is a lot of paper gold out there. The GLD is what's called paper gold. Okay, this is physical gold. And I do think they'll be 1 to 1. The Dow will be worth 1 gold ounce. That's at the end. That's the end game. That's where it ends. Now, what price that is at, your guess is as good as mine. Okay, So what I want to talk today about, we're in earnings season right now. I'm going to give you a little tip here. Now, I call myself a stock market gambler, and I'm not saying to go out and short this market. This market is not ready to go down yet. It is not ready to go down because they keep printing money. They keep pumping money in the stock market. It wants to go higher. Dude, I say it's not time to short the market. The big crash yet. It's not ready. Look, I have some XLK puts on. It's a gambler's money. Okay, that's what I do with gambling. Okay, that's my small money. Now, for investing. Okay, look at the S&P 500. On average, that's averaged over the last 40 years, right around an 8% return. 8% a year. The S&P up about 8% a year, and it's done it for the last 40 or 50 years. Okay, that's a good return. That's considered a good return. Now, I know you millennials, you're out there with your Bitcoin, your GameStops. Yeah, you do 8% in like 1 hour. I get all that. And if that works for you, that's great. I just telling you, fabulous investors. The best investors will not beat the S&P 500 over a 5-year period. Okay, over a 5-year period, 95% of hedge funds underperform the S&P 500. And the S&P 500 only averages 8%. 8% a year. It only averages that. And hedge funds over a 5-year period, they cannot beat that return. Now, okay, you got Kathy Woods out there. She's got the ARK ETF, right? Okay, last year she was triple the S&P 500's returns. She tripled the return. She knocked it out of the park. But how's she doing this year with her ETF? RKK is a symbol. How's she doing this year? Well, this year the S&P 500 is up about 17%. How's her ETF doing? Well, it's actually losing money. You see, over a 5-year period, these hedge funds, all these geniuses that run these hedge funds, well, they do not outperform the S&P 500, which averages about 8% a year. Okay. I'm going to tell you right here how to outperform the S&P 500, how to do it on a consistent basis, how to do it with less risk. All right, so the S&P 500 makes 8% a year. All right, we're in earnings season right now. They started with JP Morgan. It beat earnings, and earnings season lasts about 5 weeks. Okay, so if you want to beat the S&P 500, you have the stock market for 5 weeks. Every quarter, 5 weeks out of every quarter during earnings season. If you just go into the S&P 500 for those 5 weeks and take the money off at the end of those 5 weeks, so you're in there for 20 weeks out of the year, 5 weeks every quarter during earnings season. Okay, you will outperform the S&P 500 by over double, about 17% you'll make. The S&P 500 averages 8%. So if you're in earnings season is typically strong. Okay, if you're in there for those 5 weeks, 4 times a year, 20 weeks in the market, all the rest of the time out of the market, you will outperform the S&P 500. Now, isn't that interesting? Because you have less risk, less exposure to the market, to the down times, okay? And this market is lofty. Now, why did I not tell you to put this trade on? Earnings season started, well, it started this week. Okay, why did I not tell you to put it on? Does not work when the S&P 500 is more than 10% above its 200-day moving average. And right now it's about 13% above, almost 15% above the 200-day. When it is more than 10% above the 200-day moving average, don't put that trade on, because that trade usually loses money. The market pulls back because it's already priced in the good earnings. Okay, so I'm not in that, because it's earnings season right now, but the market is too far above its 200-day moving average. So do not put that trade on when the market is over 10% above the 200-day moving average. Otherwise, that is a great trade. Earnings season is normally a strong time for the stock market. And if you put that trade on those 5 weeks every quarter out of the year, 20 weeks total for the year, you will double the return of the S&P 500. Now, some of you are gamblers like me. You don't get excited about that return. You don't get fired up about making 17% a year because look at, okay, just my XLK options, I took a few of those off. I still have some put options, but I took a few of those off. In one day, they were up 30%. 30% in one day. And I'm talking about making 17% for the whole year and getting excited about it. That's where the difference between gambling and investing comes in. Gambling, you take your risk money and you go for it. Okay, you try to turn a little bit of money. What do most investors do? Well, they take big money. And a lot of investors turn big money into little money. But I'm telling you, the best system I know is to play the S&P 500 during the 5 weeks of earnings season. You'll average about 17% a year return on. Okay. That's just the system. I love this stuff. I love talking about this stuff. I hope you're enjoying this. If you are, give me the thumbs up. Why not? It's Friday. It's a good day for that thumbs up. It helps me out. It helps me out a lot. I'm getting almost 100 people every episode now. It's me and you, but we're gaining friends. We're gaining friends into the community. Give me that thumbs up. Hit the subscribe button if you really like this so we can talk again next week. Get out there and have a great weekend, everybody, and we'll talk again next week. Thumbs up. All right. Bye-bye now.